Hey everybody, in today's video I'm going to go over one of the better trades of the week. So in an options trade in the trading room, we made about 1,250% on an option in about a week. And I get a lot of questions on how do you find these, what's your criteria? And so I'm going to walk through one step by step, and I'm actually going to use the timestamps from when we got into the trade so you can see how we managed the trade. Okay, so it's going to be short, but it's going to be packed with information, and I'm going to give you 3 simple criteria to look at so that you can put yourself in this kind of position. Now, not always are you going to be able to get that type of return, but the goal and how I utilize options is to put myself in a position where it's possible. I'm not somebody that goes out there and tries to trade an option for 25 or 50%. If that's what happens, that's what happens. But my goal is outsized returns with options, or I would rather just simply own common stock. So we're going to dive right into it. As always, please subscribe to the channel and click notifications. And let's just address the very first thing that you need to know about before you put on an options trade. Okay? The very first thing you need to look at is this stock, especially short-term options, is this stock going to move in the direction that I think it is in the short term? If the answer to that, is no, then you don't put the trade on. Okay? If the answer is yes, you can consider putting the trade on. But that is the very first thing that you must do. You must put yourself in a position to know, yes, now the stock's going to move, and you do that through pattern recognition. So understanding pattern recognition is going to get you exactly where you need to be. Now, with that said, for those that have been following me for a while or reading the newsletter, everybody knows that I like these upper channel breaks. Okay? When we break an upper channel, what tends to happen? Okay? We have the potential to go parabolic. So I have a stock that broke out and then consolidated for 3 days, and on the 4th day, we broke out. Okay? So this gives me the potential and meets criteria number 1. Okay? Does this have the potential to move? Frankly, I look for massive potential. Okay? I had it there. That's the very first thing that I do. The second thing that I do is I go through the option chain, and I want to identify the most attractive delta. Okay? And just so we understand what delta is, okay? Delta is sometimes referred to as like a hedge ratio. It compares to the change of price of an underlying asset, okay? So it will move with the stock. So if the stock goes up, the delta will go up. If the delta goes up, more of the move comes into the option. You make more money, okay? Because let's say the stock goes up $10 and the delta is 0.5, you make $5, right? As the delta goes to 0.6, 0.7, you make $6, $7. So the goal is to be, the sweet spot for me is to be at 0.5 delta. That tends to be my sweet spot for delta, okay? And the reason for that is because I can have delta expansion. And a lot of people don't really think about that, right? But that's really what you want. You want delta expansion, okay? So that's the second part of your criteria, that you're going to want the option to have roughly a 50 delta. And I walked through this before on the Amazon trade that we did, and I'll link that one to the back of this one so that you can watch these. And you may just want to watch them just to get familiar with the terminology a couple times. But by owning that 0.5 delta, that's where I want to be. Now, the next step is for me to look at my implied volatility. This is the third portion of it, okay? You need to look at your implied volatility, okay, and make sure that it is considered low. Now, low on implied volatility, to put it in perspective, okay, to me can be anywhere between 20 to 30, okay? And understand that volatility is simply a metric that measures the magnitude of the change in price of a security, okay? The higher the volatility, the higher the risk. Maybe the greater the reward, not always with options unless you're looking for an exhaustive move to the outside. But definitely for lower it matters most. So where you want to see it, where you really will see it matter, the lower volatility number between 20 to 30 is when you're sitting here, okay? So as everybody knows, I love these charts. You break an upper channel break, we have the chance to go parabolic. That's exactly what happened here. Now, what we did was very simple. On the 29th, okay, we have our 3 criteria. So I go out there on the 29th and I state, and I'm using these timestamps from the trading room just so people can see that it's actually true. So I think that's somewhat helpful. So I go out there and state on the 29th to buy these options, okay? Calls at 260 for November 5th at 3:30, okay? So we're paying $3.30 an option, okay, for November 5th calls, all right? Now, the next thing that we do, okay, is we stay in them because the stock's doing what we expect it to do. 29th. Now here we are the next day, November, right? Now, November 2nd, okay, the stock moves, okay? When it moves on that date, what I do is I implement a system to protect my capital, okay? So by the end of November 2nd, we were up 75% on the option and we moved the stop to break even. Okay, so the most important thing to understand is you must know how to quantify your risk, and you must have a system in place or a process that allows you 2 things. 1, to protect your downside, and 2, to allow the trade to play out. I can't be any clearer on that. You must allow this trade to play out. Okay, so we have our criteria. We've met our criteria. The stock moves up, or the option moves up 75%. We know we only have 3 days left in the option, right? What do? We move the stop to break even. Worst case now is break even, okay? Next day is November 3rd. All right, and then after November 3rd, what we have, there's not really anything to do, and we know we're going into the week. So then the 4th hits, November 4th hits, okay? And now we have this gap. So on this gap, that's when you need to change your strategy. And what we're doing is we're moving it up every single time. We are moving up our stop to protect our downside and protect our profit, okay? But we don't want to limit the upside. So what we do is we know that they're expiring tomorrow. We know at this point off the open, okay, that we're up around 300%, right? So it worked the way that we thought the trade was going to work. The implied volatility increased due to the momentum and magnitude of the move, which is what you want, and the delta expanded, okay? Plus the right strike price. So all 3 of those things, delta expansion, right chart, implied volatility, all 3 of those increased. The stock played out the way it was, the implied volatility went higher, the delta went higher. Okay, all that added to when we come in, and now this is up roughly 300%, okay? Now, at that point, you can consider trimming into strength, and my point at the time was very simple: move the stop to 100%. So worst case scenario, the next day the option's going to expire, and our worst case scenario is a double, okay? Now, for this next part of the trade, when something starts going parabolic, you have no idea where it goes, okay? We've all seen this play out before. This week, it happened with Avis Car Rental, where people got caught in a short position and it went up 5-fold. Okay, you don't know where it's going to end. So your goal is to stay in the trade, okay, and manage the trade, but do not limit your upside. It's the single greatest mistake is limiting your upside. Some people will trim into it or raise their stops tighter. That's fine, but you must allow it to stop you out because you simply don't know when it's going to end. And I would argue that anything else is just, you're really limiting your potential, okay? So once that kicks in, okay, we just start moving the stop up. And all we're doing by moving the stop up, okay, is understanding where we're at, okay? That's all we're doing. So this move here, these three, right, everyone knows this position or might not know that this is like, it's called three soldiers. But right now, when you're up here at 285, you're looking at this and going, is this something that can continue to keep going, right? The implied volatility is expanding, the delta is expanding, okay? And we're in the money. So, you know, and by in the money, the strike price is lower than where the stock is. So now what we do is just move the stop up. Okay, so geez, well, up at this point, we're at like 700%, okay, off the rip in a short period of time. So then we look at it and very simply go, all right, well, I'm willing to let this go a little longer, but what we're going to do, we're going to move the stock up as the trade progresses. Okay, that seems reasonable. So the first move is up 700%, move the stop up 500%. Okay, next move, all we're doing is looking at the chart and going, well, that worked. Here we go again. Okay, so now we're up 900% and we're 50 points at this point, right? 40 points, 45 points in the money. Okay, so you see how this is going? So you can see how that could play and how you, right? You're hopefully you're getting it. So then you move the stop up, and I think at here we called it 750 gain. That would be the stop. And then we just kept moving it up, okay? Then it kept going. We went up again. Then we were up 1,100%. And then we just kept leaving this here and saying, okay, well, if it gets under 850%, then we'll close it. And what you're trying to do here is you're trying to mitigate your risk. You don't want to move it up in 10% increments because that could be a sneeze when you start moving like this, okay? But what you need to do is you need to break down your time frames, and you must trade according to the stock chart, not according to what you want to happen, or you'll wind up limiting your gains, okay? Some people will just say, oh, I'll just close it, I'm up so much. And if you did that in this position, okay, you missed over 15 points, okay, and substantially more because the delta expansion and the implied volatility, okay? So after moving it up, we then move it up again, okay? You continue to raise, you break out again. You're at 301 at this point, okay? So now you're at a place where you're $40 in the money. The implied volatility is kicking in. The delta's kicking in. You're almost at a 1 at this point on the delta, right? So the delta expansion happened for us. What does that do? That gives us another position right here, okay? By the time we're done, we're up 1,200%. We move the stop to 1,000%. So now we have a position, worst case scenario, that's tenfold. To put this in perspective, if you simply sold off the open, okay, you would have missed, well, I can do it through this on a percentage basis, but just if you sold it off the open price, okay, and this was your move, okay, you missed a 15% in the money move, 40 points on the option, okay, by not having a game plan and just locking something in. So I would argue that the way that I move the stop up may be a more proficient way for you to think about doing this. Okay, and eventually we know we're going to get stopped. We just don't know where. So next is very simple. After we break out, we continue on this breakout. You're like, wow, we're setting up. Okay, 1, 2, 3. All right, 4. Okay, we're up 1,500% at this point. Okay, we simply move the stop to a position, okay, which is roughly a percentage off of that 1,500, and we move it to here. Okay, that was it, because we're getting to a point where we keep moving the stop up and moving the stop up. Okay, you can trim into it if you like, depending upon your position size, but you want to hold some. So that's where we put the stop. Okay. Next trade is we have, everybody will know this if you watch the candlestick video, and I'll link that at the end. This becomes very simply a bearish engulfing. It engulfs this other bar, we get stopped out there, and we lock in a 1,250% gain, okay, if we, for whatever we didn't trim on the way up. And we're completely and utterly out of the trade, all by following 3 very simple processes, okay? First, we had our indicators, right, which is what we wanted to look for, which was a stock that has the potential to move aggressively to the upside, right? So we have that. We have the delta at 0.5. We have the implied volatility no greater than 30, okay? And what does this do for us? It puts us in the right position. Then we do the second thing is we utilize the correct chart. Okay, in this case, it was the 15-minute. Okay, that's the second thing we did. We utilized the correct chart, the 15-minute, and if you're trading on a weekly basis on an option, use the 15-minute. And then we used pattern recognition to determine when we should raise the stop or get out. And the third thing that we did was we used a trailing stop. And by using a trailing stop, it allowed us to stay in the trade longer. So that's it in a nutshell. I know I threw a lot at you. As always, if you could please share this video if you found value in it. I purposely don't run ads in the middle. And comment on what other criteria you want me to do in regards to options. I get asked a lot of options questions. I don't know if I should be doing more beginners or intermediate, or if this is too advanced. So any kind of clarity that you could give me would be great. Thank you very much.